Two investing legends, two completely different paths, one unforgettable lesson. If Warren Buffett and Peter Lynch were handed the exact same company today, there's a good chance they wouldn't make the same decision. One would patiently ask, is this a wonderful business I can own for decades? The other might ask, is this a hidden opportunity the rest of the market hasn't noticed yet? And here's the fascinating part. Both approaches created extraordinary wealth. So who's right? The answer might surprise you. Warren Buffett built his fortune by believing that time is the greatest investment partner you'll ever have. Instead of chasing the hottest stocks, he searched for exceptional businesses with strong competitive advantages, honest management, and the ability to keep growing year after year. Once he found them, he didn't rush to sell. He waited, sometimes for decades. Buffett understood something most investors struggle with. Wealth grows quietly, not dramatically. Like planting a tree, the biggest rewards come to those willing to let it grow. Now here's where it gets interesting. Peter Lynch looked at investing through an entirely different lens. While professionals searched through endless financial reports, Lynch believed ordinary people often spotted great businesses first. The restaurant that's always full, the clothing brand everyone suddenly wears, the product your children can't stop talking about. His famous idea, invest in what you know, wasn't about guessing. It was about paying attention to the world around you and then doing the research before everyone else caught on. At first glance, Buffett and Lynch seem like opposites. Buffett focused on buying outstanding companies at sensible prices. Lynch was comfortable exploring fast-growing businesses that others overlooked. But beneath those different strategies was the same powerful psychology. Neither man invested based on excitement. Neither chased headlines. Neither allowed fear or greed to make decisions. They relied on patience, discipline, independent thinking, and careful research. That's the lesson most people miss. Successful investing isn't about having a higher IQ. It's about mastering your emotions when everyone else is losing theirs. So which strategy should you follow? The better question is, which strategy fits your personality? If you're naturally patient and enjoy holding investments for years, Buffett's approach may feel right. If you're curious, love researching businesses, and notice trends before others, Lynch's philosophy might suit you better. You don't have to copy either legend. You need to understand the principles behind their success and build a system you can stick with through every market cycle. Here's the thought worth remembering. Peter Lynch proved that opportunities often hide in everyday life. Warren Buffett proved that patience can transform good decisions into extraordinary wealth. Different paths, different personalities, the same destination, long-term financial freedom. If you enjoyed this journey into the minds of legendary investors, subscribe and join us for more timeless lessons on investment psychology, wealth building, and the habits that separate great investors from everyone else. Sometimes changing the way you think is the most profitable investment you'll ever make.